best accounting picture ever. And the fact that it actually made me laugh, I think, is an achievement. So, as that picture, not to mention the title, might have given away, that we are talking about a balance sheet, which is one of the main methods that accountants use to keep track of things, and how business owners and decision makers make decisions with that info. So, business and financial statements present financial info in a way that helps businesses keep track of the financial health of a business. So basically, how things are going, what kind of money do we have, what liabilities do we have, what assets do we have, and all that info is at the core of virtually any major decision that a business or a manager will make. And so the two financial statements that really come into play here are the balance sheet and the income statement. And in this video, we're talking about the balance sheet. But first, if you remember from our intro video, the things we need to know: assets, liabilities, and owner's equity. To review, assets are things owned by the company that produce revenue or aid in the production of revenue. Liabilities are money that's owed by the company to someone else. And owner's equity is the difference between the two. It's considered to be the net worth of the company, or how much owners have invested in the company. And they're kind of big deals. So the balance sheet. The balance sheet is a snapshot. So companies are doing things all the time, and at any given time, different stuff is happening. Different transactions are happening. Things are being bought and sold and created and disposed of. And so a balance sheet is a sort of an instantaneous X-ray, if you will, that shows exactly what's happening, but at a very specific point in time. And it does not indicate whether the business is making a profit. It's just concerned with what's happening at this exact second. Now, the balance sheet equation is also known as the accounting equation. And the reason why we call it a balance sheet, and why we call it the balance sheet equation, is because the equation must be balanced at all times. When I say balanced, I mean that the left side is equal to the right side. You might be getting some math pangs from this, some faint recollection of something to do with math, where you've checked to make sure the left side equals the right side. So here is the almighty accounting equation. Assets must always equal liabilities plus owner's equity. Now, you can rearrange this equation by taking liabilities and moving it over here. To do that, you subtract liabilities from this side and then this side, and that's what gives you the whole assets minus liabilities equals owner's equity. That's where that comes from. Just a reminder, assets are things that provide future economic benefits for the company, i.e. cash flows to the business or future services to be used. What that means is that assets aid in the production of revenue. So, for example, a house is an asset because it aids in the production of revenue. It's owned by the company, and we use the house to store things and to serve our clients or whatever it is we use the house for. A truck is also an asset because it aids in shipping goods and services from the business to the consumers, which plays a big role in generating cash. Liabilities are things that will result in the future outflow of economic benefits. In other words, money is leaving the company, so we're losing money. And these things are usually debts or obligations owed, not owned, owed by the business to a third party. Okay, so equity, aka net worth, capital, is the difference between assets and liabilities. Now, owners can directly contribute to owner's equity by investing money or by withdrawing money, which would negatively impact owner's equity. But the thing to remember basically is just how much the business is worth to the owner. Okay, so let's talk about how to prepare an actual balance sheet. Businesses use balance sheets all the time in order to get an idea of where in this exact moment we stand. It's kind of like running a diagnostic, on a machine or on anything to see where we are. It's very important to know where we are as a business so that we know what we're capable of doing. And I'm sure you can imagine how big a role that plays in decision making. Okay, so when preparing documents of an accounting nature, because they're all legal documents and they're subject to legal review, they have to be prepared in a very specific way. And the reason behind that, number one, is to comply with the law. Number two is to make reading of the statements and drawing meaning and value from the statements as easy as possible. I'm sure you guys have all read books that were overly complicated, maybe Shakespeare, cough, cough. Or you've read a textbook that really doesn't organize the info well, and you're sitting there like, why didn't you just say that? It's so annoying. Since financial statements can get pretty complicated, there are set guidelines on how they should be prepared to try to avoid that, so that anybody who knows how to read a document can read it very quickly. Anyway, first step is filling in the statement heading. So it's 3 lines, they're all centered, and they're all at the top of the page. And they describe the who, what, and when. So first line is who, the name of the business and the organization. Second line is what, so the name of the financial statement. In this case, you'll say balance sheet. And then the when is the exact date, sometimes even the time, that the balance sheet or the snapshot was taken. So that's step 1. Pretty easy. And there's an example of what it might look like. Now I want a sandwich. All right, let's move on. Okay, so this is a simplified, look at those animations, eh? This is a simplified balance sheet. For most businesses, it'll look more complicated than this, but this shows you, it shows you a lot of things. First of all, it shows you the format of a balance sheet. Notice also how the assets are on one side and then liability plus owner's equity is on the other. Isn't that cool? Well, it's kind of cool. It's nice that the sheet mirrors the equation. So we have a bunch of different assets listed here. We've got cash, accounts receivable, equipment, buildings, and total assets. And don't worry, I'll explain what these are. I'll explain what all these are. But these are common assets, liabilities, which is money owed by the company to someone else. And then owner's equity down here, which explains the sort of net worth. So yeah, look at this, Isn't this pro? So assets on the left, liability plus owner's equity on the right. Okay, step 2 is list the assets, and you'll see on the sheet here we've got the assets listed, but they're always listed in a specific order. And the reason for that is so that when people are reading these statements, they can find the stuff they're looking for as quickly as possible. Then you don't have to spend a few minutes searching through the sheet. So assets are listed, they have to meet this criteria. And we've talked about this already, it's just worth repeating. They provide future economic benefit, i.e. they help you make money. And the cost principle. Now, you don't really need to worry about this, but it's a very important legally binding principle, so I put it in here. Any assets that you get, let's say you buy a car, you will record that at the historical cost of the car. In other words, the cost that you paid for it. Same thing with houses, same thing with everything. And the reasons for this are a bit complicated, but basically it is the clearest, most concrete way to record what you paid, is actually recording what you paid. Now you might be asking, what's the alternative to this? The alternative is to write it according to the market value, so what the market thinks these things are worth. We generally don't do that. There are some exceptions, but I'm not going to get into that. It's just important to remember you record your assets for what you paid for them, not what someone tells you they're worth. Okay, let's press onwards. Now, when listing assets, I mentioned that there's an order, and there is, and it's called the order of liquidity. Now, for anyone who doesn't know, liquidity is how quickly an asset can be turned into cash. Not literally with magic. I'm just kidding. I know you know that. Anytime you sell something and you get cash for it, that's called liquidating something. And the reason it's called liquid is because cash is the easiest flowing source of currency. So it's a bit metaphorical, but that's why it's called liquid. So different assets have different rates at which they can be turned into cash. For example, it's easier to sell, and this might change, but it's easier to sell, generally it's easier to sell a car than a house. Now, this will depend. In Ottawa, the housing market is absolutely insane, and houses get sold within a day. It usually takes longer than a day to sell a car. So you might change the order of things, but right now, usually equipment is considered to be more liquid. And a better example would be a building. It is definitely easier to sell a car than it is to sell a building. So in the balance sheet, you would have car up here and then building down here. Cash always comes first because it's the most liquid thing. I mean, it is the liquid, metaphorically speaking. So yeah, generally the order that you list stuff is cash, which is, I mean, you know what cash is. Accounts receivable. Okay, so accounts receivable is a fancy way of saying money that's owed to the business by the customers. Anytime someone buys something with a credit card, it goes under accounts receivable. And so the standard, I guess, understanding is that the money will be paid within 30 days by the credit card company to the business. Next is inventory. So this is stuff, items that the business is going to sell. So if we sell, I don't know, if we sell sandwiches, our inventory would be sandwiches and it would be ingredients. Now, supplies is different than inventory. Inventory is what businesses sell to customers. Supplies is what businesses use to conduct their daily business. So this could be paper, pens, highlighters, stuff like that. There's a pretty broad umbrella that covers both of these things. Anyway, so you'll notice that these are all listed in order of how easy it is to turn them into cash. Cash always comes first because it's cash. Accounts receivable is always second because we know that we're going to get the money in 30 days. So it's pretty easy. All you got to do is wait 30 days and it turns into cash. Inventory. Seeing as how the business is designed to sell its inventory, it's reasonable to assume that it can sell its inventory pretty quickly. Supplies are a little less liquid because the business was not designed to sell these supplies. It was designed to sell the inventory. So supplies are useful, so they'll still sell, but probably not as quickly as the actual inventory will. Does that make sense? Anyway, so hopefully you get an idea of the order here. Just remember order of liquidity, how easy it is to sell something. All right. Now, a specific type of assets are called fixed assets. And these are items that the business keeps for a long period of time. Stuff like cash, Cash changes hands very quickly on a minute by minute basis. Accounts receivable changes hands pretty quickly too, within a max of 30 days. Same thing with inventory and supplies. Inventory gets sold fairly quickly, supplies get used up fairly quickly. Land is kept for a long time. So our buildings, same thing with equipment like machinery, furniture, vehicles, when we list fixed assets, we list them in order of the asset's useful life. And the longest useful life is first. So we're sort of doing the opposite now. With current assets, we list them how quickly they can be turned to cash. With fixed assets, we list them for how long we can keep them. So it's almost the opposite. Land is always first because land, in theory, will last forever. Assuming that there isn't a gigantic earthquake that swallows up the lot, it's going to be there forever. Buildings, same thing. Buildings stay for hundreds of years. Next is equipment. Who knows how long equipment lasts? It doesn't last as long as a building, but it lasts a very long time. And then furniture, and then vehicles. So this is usually the order. And again, it's longest first, and land always comes first. So here's an example of the asset side of the balance sheet. And so we got cash first, accounts receivable, building, equipment. Remember that these are historical costs, how much we paid for this stuff. So current assets listed in order of liquidity. Long-term assets in order of useful life. Step 3, list the liabilities. So we're going to the right side of the equation now. Whoa. There we go. Liabilities represent a future sacrifice or obligation. They have to be the result of a past transaction. So the business has agreed to make this sacrifice. It sounds so melodramatic. But yeah, that's how liabilities work. The most common liability is called accounts payable. Same principle as accounts receivable, except instead of receiving money from customers, we are paying it to somebody else. So once you understand the names, they're helpful, right? Like, remember, accounts payable is what you pay to someone else. So you're liable to pay this. Now, liabilities are divided similarly to assets in that there are current liabilities and long-term liabilities, instead of calling them fixed, because they're not fixed. We deal with these over time. So current liabilities, debts that must be paid within a year, and we list in order of accounts payable due. What that means is that we list the ones that we have to pay earliest. We list those first. Now, long-term liabilities are debts like mortgages or loans for machine equipment and stuff like that. Now, these take often much longer than a year to pay back. And so we list these in the same order, in terms of we list the ones that are due the soonest first. So the liabilities that are due soonest are the ones we list first. And there's an example of a mortgage payable here. Okay, so here's an example of what the liabilities section would look like. If we have some accounts payable to a store that makes buns, like hamburger buns or sandwich buns, we'd have that first because accounts payable is paid within 30 days, same as accounts receivable. And then next we'd have loan payable. So this would be paid in a couple years, let's say 5 years, who knows. Now, if we had a mortgage, usually mortgages are taken out to 25 to 30 years for a house. So let's say we have a 25-year mortgage and we're 4 years in, so we're at year 21. 21 is bigger than whatever this loan would be. Let's say it's 7 years. So then mortgage would come underneath that. It's not in this example. I'm just saying if we did have a mortgage, it would be at the bottom. And then we have total liabilities added up here. So here's our current liability. Then our long-term liability. And that's it. So step 4 is calculate owner's equity. BS stands for balance sheet in this example. So using the balance sheet equation, you can rearrange to calculate owner's equity. OE stands for owner's equity. So assets minus liabilities equals owner's equity. So you remember the original equation is just assets equals liabilities plus owner's equity. So mathematically speaking, we just have to subtract liabilities from both sides. And that cancels it out on the right side and brings negative liabilities over to this side. So assets minus liabilities equals owner's equity. So we just plug in our numbers and we get 60 grand or 60,625 minus 26,520 is equal to 34,105. So this is the owner's equity. This is the net worth of the company. And it's the difference between assets and liabilities. And then putting it all together, can I make that bubble go away? No, I can't. All right, so then we just, the rectangle, it is the bane of my existence.
It doesn't matter what presentation you're making. I will always be here to interrupt you and make your presentations difficult.
What do you think of my bane? Do you think it was all right? Let me know in the comments. That way I'll see if you've actually watched the video. These take forever to make. And this way I'll know if someone's actually watched. I don't know how far we are into it, but yeah.
Leave a comment below telling me what you think of my impression.
All right. Okay, so here, oh my God, the owner's equity section. You know what? Just because it's so annoying, I'm gonna.
The owner's equity section. First, we list the owner's name and the capital.
Oh yeah, I guess you won't. You may not be able to understand what I'm saying. First, we list the owner's name and the capital. What this means, by the way, is that, oh my God, everyone be really still. Okay, it's gone. What that means, I can't move the mouse because it'll get the rectangle back. What this means is the difference between the total liabilities and total assets is that much. So see, total assets is 60,625 minus total liabilities 26,520. So that's what this means. Okay, we can let the rectangle back. Now then we add up total liabilities and owner's equity. So we add this number and this number to get this number. And you'll see that this number equals.
And now we wait for the rectangle to disappear. And you see, oh God, it's back. You see that total liabilities and owner's equity equals total assets.
Alright, so you see they're equal, and that's how you know it's balanced. Is if I move the mouse, it's just going to come back. We can see that total assets equals liabilities plus owner's equity, meaning that everything's balanced. So that means you did the thing correctly. If this if this and this is not equal, you've done something wrong. Something's happened. Okay? Okay, balance sheet conventions. So no abbreviations. Unless the company name is abbreviated. No corrections or changes on the sheet. So, I mean, we're doing this digitally, so it doesn't really matter. Now, in grade 11 and 12, I'll get you to line up your dollar signs, but don't worry about it for grade 10. Now this is kind of important. In fact, it is important. You underline totals and you double underline final totals. And part of that is just, it helps symbolize what you're actually doing, and it also makes the numbers very easy to find. So always underline totals, like regular totals. So total liability. And you double underline final totals. So this and this. Now, I can't double underline in Google Sheets right now, or at least I couldn't figure it out. That should be underlined. It's not. I'm not sure why I underlined it, but like, I don't know. It's not showing up. Anyway, I did it. I did it. I swear to God. And these should be double underlined. I hate the rectangle so much. You don't even know. It makes me want to help Bane take control of Gotham City just so we can take over Google and rewrite the script that makes this thing pop up. Where was I? Yeah, so this, like, if you're writing this by hand, oh my God. This should be underlined, and so should that. Oh, good Lord. If I had a blooper reel, this would go in it. All right. So here's some practice. Given the following info, prepare a balance sheet for Luigi's Repair Shop, owned by Luigi, on today's date. Just remaining calm. That's what I'm doing. Just deep breath. All right. The rectangle's gone. It's gone. That's another thing about accounting, by the way. It's very relaxing. Like sorting stuff and putting it in order. So try that out. And I think I have the solution on the next slide, so just spoiler alert. Bam! And look at this. No, the rectangle covers my cute picture. There. Look, the cat is mind blown. And they're equal, which means the balance sheet has been done correctly. Anyway, that's it. There's balance sheets. I am so done with this rectangle. Oh my God. Anyways, I'll see you in the next video. Yeah, see you later.